Really, it all starts at the corporate level in regards to the corporate structure. These corporate entities are registered and they have sort of like their own life in regards to like, think of it as if like they can have like their own debt. They can make money and they even have their own number, like a number that identifies themselves for the purpose of taxation. And also they have a credit score. So it's almost like it's almost like a person in a way where like these corporate entities, like these businesses, these corporations, like they're almost like a person in the eyes of the law, and they can be taxed like a person. They can get a credit score. They could borrow money based off that credit score. Um, and they could like, well, hire people. So it's like a little different from a person, but essentially the way that they're set up, um, they have like this thing called equity, where like certain amounts of this corporation are shared amongst the shareholders, the stockholders, and they can have a percentage of ownership of this entity. So that's what stockholder equity is. But like for an LLC, which is like member managed, um, you wouldn't have like shareholder equity or stockholder equity because LLC doesn't have stock. Instead, like the members have like a certain amount of ownership. Um, so like a certain amount of ownership within the LLC, within the corporation, and then like the losses and the profits are distributed based off the ownership rather than like dividends. Um, so like because there's like individuals as well as like this corporation, like this corporate entity as well as like individual people. But like the entity sort of like receives money from people, as well as from other entities, from other corporations, as well as like giving money to other corporations, as well as giving money to individuals. Um, there's going to be taxation on basically almost every single level, every single transaction that happens, you'll see like taxation. So that's like one of the reasons why it's so important, like taxation of like the transactions that this corporate entity makes. Um, but then like it doesn't end there because like there's like this thing called like a stock market. Right? So like before there's like primary stock market, you could like own like shares of this company and then you would receive like a certain amount of money based off of like your private shares of this organization. But like later to like raise more money from like uh, more like on the consumer side, really, to sort of allow like retail investors to like buy shares because like there's like a lot of people like retail investors that are looking to like invest into a company, um, to share in the losses and to share in the gains of a company. So like that's why the SEC, the Securities Exchange Commission, was formed to protect the consumer, um, for like from like things that could possibly happen. Like banks have their own thing. Like I forget what some kind of like other There's a bunch of financial organizations that like handle securities in regards to like financial securities. um, and like having like backings by like the federal government, and there's like the um, like what's it called, the the reserve or whatever, the place where they print the money and stuff. I mean, like they can like they like print out a certain amount or they don't, or like you set interest rates and stuff like that. But the SEC was born, and the SEC was created to regulate these stock markets. Um, and like one of the methods of regulation was by having these company entities to pretty much put out like this public forum to like let this be widely available to the public. And those are the 10K and like the 10K, 10Q, which are those are just basically like pretty much just like income statements or like cash statements of cash flow and the balance sheet, you know, the financial statements, like the main financial statements in regards to like the income statement for the company. And like there needed to be like a standard way to like write up these documents. And so like the SEC gave like permission to FASB, which is like this accounting board, which allowed them to like create this like thing called the GAAP, generally accepted accounting principles, at least in the United States, um, to write up like these like balance sheets, income statements, and they created like debits and credits and journalization and like how it all works together. So that's like the way that it's all like started. That's like the gist of accounting and like how accounting came to be. So like the owner equity and the stockholder equity is like a really important part of the equation because like there's assets and liabilities. So like obviously like when you think of assets, like an asset could be cash, which is like a current asset, like short-term assets, as well as liabilities, like expenses, payables. So like if there's revenue or like income, that would be like for example a receivable. So you guys can like see like how like this company can like have assets in regards to like accounts receivable, like money that they plan to receive. Um, this credit score, like this corporate business credit score that allows these corporations to borrow money, business credit, um, for like is reported by like suppliers, and then they like have their own like for like consumer credit. You have like Experian, TransUnion, what's the other one? But you have three major like credit reporting bureaus that report like consumer credit. But like for business credit, they have like not like really a bureau, but like sort of like suppliers that like let them know like oh they like paid their payable, like their accounts payable. Um, but like there's smaller amounts of money. Like for example, because it's really related to inventory. Because like these corporations um, operate on credit. So like there could be like a smaller like a tab. For example, like if you go to a bar, you go to the bartender and you could give them your card and they open a tab. Like a very short term like lending situation where it could be like a very short period of time where you like run up your tab, and at the end of it you pay it. Like a certain amount of time you have to pay that tab. Likewise, they have for like AP, AR, like accounts payable, accounts receivable, there could be like a discount that's given to um, like inventory that's, or like if it could be just a cash, for example. It could even be just like straight up borrowing money, but most companies don't make money lending money. That those are like lending companies. So they charge interest rate on the money that's borrowed, and then they're like a bank, uh, or they could be like a private, well, like a smaller company that's not a bank, but they still lend money, and then they still get an interest rate. So like they're like a financial services. So like their whole business is related to lending money and then getting an interest rate on the lent money. So they don't really operate on inventory, but most companies do operate on inventory, as in like they are either manufacturers that manufacture a product or they're something like the service industry. Um, so there could be like, for example, unearned service revenue, or like inventory that's like lent, like this inventory is borrowed, so to speak. Like they give the inventory ahead of time to the company. Uh, so like for example, it could be like a 110 net 30 or net 45. So like 110 as in like 1% discount if paid before 10 days. Otherwise paid in 30 days or 45 days. So that's a pretty common lending situation for like manufacturers that manufacture these products. Or like for example, it could be like raw material. Like it could be a business that gets raw material and sells raw material to other corporations. Manufacturers that take the raw material and then create the product, the inventory. And then that inventory is sold to the company that sells the product. But that's really short term. So like larger lending situations, like for example, most of the time they're not going to do like type of no payable. So like a no payable is going to be like something that's over a month or like 3 months. Um, like a short term note. Like one of the examples of a note is actually federal um, treasury bonds, treasury notes, for example. But like a treasury note, like it's actually a note that you get from um, the Treasury Department. The government sells these notes and these bonds. So, for example, you could buy a treasury note. This treasury note is for like a shorter period of time. For example, it could be like 3 weeks, or it could be like 3 months. And there's a set interest rate on the note that the government will promise to pay. It's backed by the government, so it's like a very low interest rate based off of inflation. Um, but that's like a note, so it's like a very short-term borrowing situation. It could be upwards to like a year, for example, or like maybe even 3 years, like a 3-year note. That's sort of like a longer note, but like this note could still have like an interest rate, like as in like an issue rate, um, or a coupon rate. But then like there's a market rate, as in like this note goes on the market, and then there's like based off of like the market, there might be like a certain percentage of interest that a different borrower, they'll actually buy that, they'll actually take the note and then like front the money and then sell it again. There's a third party within that situation, that's willing to take that note and then resell it for a higher. Most of the time, it's probably gonna be for a higher interest rate, like for a higher market rate, because like if the market rate is higher than the issue rate, there will be a discount on the note. So like if there is a discount on a note, then for example, the lender would actually pay less cash to the borrower, but the face value of the note remains the same. But then like I mean, it's pretty much the same for a bond. But the thing about bond is that it's for a longer period of time, like 10-year bond or 20-year bond or 30-year bond. So the so like these bonds and these notes, pretty much what happens is that there's like this thing called like additional paid-in capital. Um, so like capital is part of owner's equity or stockholder equity. Like owner's equity is mostly related to like things related to like membership managed. Uh, but then like stockholder equity, if a company is like mainly like a C corp or S corp where they do have like stock on the market, then most of the equity is going to be related to the stocks or like the shares of the company. So it's more like stockholder or like shareholder equity. But it all is like related to owner equity. Owner's equity, equity. Um, so like the assets plus liabilities equals the owner's equity. Right? So like all of the assets of the company and all the liabilities of the company equals like the capital or like the owner's equity. Um, in regards to like the retained earnings. So like for example, company makes like $1,000 a year, and the liability is like 500. So then like the retained earnings, as in like the remaining amount of earnings, is $500. So that's the remaining equity. So like the shareholders or the stockholders, or the members, dis they distribute that retained earnings, um, usually in the form of a dividend. Uh, so like a dividend is like the way that those earnings are distributed amongst the shareholders. Um, and of course, there's preferred common stock. So like this is really important. Owner's equity. Um, so like the whole point of this is in regards to like that dilution, as in like the ownership can be diluted. So um, like and because it's about control of the entity. So like the dilution of like for example, like majority shareholders. Like a shareholder has like 51% of the stock, right? So like they're the majority shareholder. So like because of the majority, they can like what happens is like they have like these meetings. They have to because of the structure of the company, like this corporation. They have to like do business minutes. They have to have like um these meetings pretty much with like the president or the vice president, blah blah blah. They all show up, and they make decisions for the company. Um, and then like they vote on like various things. They could vote on a lot of things, but just like a board, right? Um, I'm not really sure. Like sometimes the president has like the majority of the shares of the company, or like the president is hired by the corporation to sort of like make like tactical decisions. But then like the majority shareholders can like have like decision making privileges. For example, like firing the president. They could fire the president, um, and like replace the president with a different president. So they have that decision-making power. If like there is like a shareholder or stockholder that doesn't even work for the company, they might be on the board, but like they don't necessarily work at the company. They're not working as a president. They actually might not even have a role. They don't have a job at the company. Um, but like they own the most amount of shares. So they're like the majority shareholders of the company. So like they have like let's say there is like a majority shareholder that has like 51% of the shares. So like what happens is like they have like the majority control of the company. So like if it came to a vote based off the shares, they would be able to make the decisions for the company. Um, but like it's not malicious. Like they're not maliciously doing this. But there could be like things they could do, for example, like business decisions to purposely dilute a stock of a company. Like the dilution of stock, like as in like the dilution of their ownership. Like they could purposely dilute the majority shareholder, like for example, one of the things, but like they're not gonna like they might there is a chance of it being like this malicious takeover. For example, there could be like a takeover situation where like the whole purpose of it is to take over a company because like for example, these shares are valuable and they could be like sold. Um, the company could be sold. The company could be closed. There could be so many decisions and so many things that could happen to this company um, that like these decisions wouldn't be made without the authorization of the majority shareholders. Um, so like if there is a sort of like a malicious party, or for example, they could like do something as such as buy the stock. They could like just, hey, how about this? Or sometimes maybe the stock isn't even for sale. They want to be a majority shareholder, but they can't because the stock's not for sale. Or the stock is for sale. So like for example, they could just buy the stock and then they could be the majority shareholder, you know? Um, but like one of the things that the shareholders can vote on is like for example the issuance of additional shares. So like with the issuance of additional shares, it will actually most likely be like a diluting event where like it actually causes the other shareholders to actually own like a smaller percentage of the company, although the number of shares that they own is the same. Um, so like they can do that. But shareholder equity and owner's equity is a really important thing. I would say it's like one of the most important parts of all this. Like if you guys are able to understand like how like these things work, it's a really important thing to know about like how it all works behind the scenes. But um, as well as like well, really what it is for accounting is like the reporting of these types of things that happens. So like how to like understand how to write up like various things. It could be like a detachable warrant. Um, it could be like how to calculate certain things. Like the meat and potatoes of it all is like uh, accurate recording of these events because like you can't really like fake the numbers. You can't really cook the books. As in like you can't make these numbers up pretty much. So like because like the in and outs of all this, like if if there's two organizations that like are like doing transactions with each other, if they write the transactions incorrectly, every single step of the way, like no matter what it is, like no matter what entity it is, there's gonna be a record of like what goes where, what goes where, what goes where. And, like it's gonna go from here to here. If there's like this mismatch, it's like this discrepancy, then you'll be like, where did this go? Right? That's the real question, you know. It get lost. I've just been lost, for example. But there's like this real chance of like, well, like a malicious thing that happened. Um, right? So like you guys have to understand like this could be like this thing that you have to watch out for, actually. Like something to think about in regards to like, oh, this is something that I need to watch out for. Like where the money is. You know, it's like you sent it into this place and it's gone, right? And then you have to ask yourself, where did it go? Because it went somewhere. And like that's really like the basis of like, for example, like you could be like doing an audit. You know, you might want to do an audit, especially when like there's so many different ways like it could be sent in so many different ways to so many different places that like it gets confusing and like there's like for example tax. Um, there's so many situations and like opportunities to work between the lines of tax to find like, oh, these are the laws, and then they're working with between the lines of the law, or sort of like finding like the best way to do this to get the highest tax refund. Right? Um, but like when it comes to a certain point where like they're maliciously trying to like circumvent the law, um, it becomes this thing called fraud. So like just something you guys should think about when it comes to like this stuff, like this business stuff. Um, there is like a very important part about this that we haven't really talked about is like this thing in regards to like this thing um called fraud. And like the best way to combat fraud is by doing audits correctly. Like auditing correctly and understanding like where everything's going can reduce fraud um, and prevent fraud from happening. Uh, like financial crimes, because the fraud is a financial crime. It's a white collar crime. So like if you're able to do audits as well as like to understand like how the law works, if there is an actual malicious, because like fraud is gonna be like this malicious thing, like it's purposely done. Um, so like they're actually trying to do a crime. Like they're actually trying to do like a they're actually like a criminal that actually doing like white collar crime. Because that's what a fraud is, white collar crime. So like the best way to combat fraud is to and prevent fraud is to do audits. Like auditing would be like the step to take in regards to um, discovering like what is happening. Like for example, there could be like some type of structure, some type of thing they built to hide, like a shadow, or like a dark place, like a darkness, where like this money is going, uh, like for whatever reason. Like we don't know why. Most likely it's because they're trying to avoid tax. One of the biggest things they do is to not pay tax. Uh, Trying to reduce the amount of tax you want to pay is okay. But like if they're purposely trying to avoid tax is one of the things that they might be doing. That's actually something they shouldn't be doing is avoiding tax, uh, as well as like other types of things they might be doing. We don't really know. But at the end of the day, um, my suggestion to you guys is to lead with auditing. Uh, if you guys are like serious about this, like, uh, and like you might come to a place where you guys are in a situation where you're maybe personally or like um, you're at a job and then you're asked to do something you know is wrong. You know, you guys have to think about like your ethics and your morals and really the law and like to follow the law even if like that's gonna be against from what they're telling you to do. Um, because like the business can't tell you to break the law. So like you guys have to make sure to follow the law even if the business tells you to break the law. Um, and like in this situation, they might ask you to write a different number in there. You know, that's like something that they might ask you to do. Is like to say like, oh, actually this is the number, but it's not correct. That's not the correct number. And the reason why they're putting that number in there, you know, who knows why? You know, you're just following orders. But there could be many situations where like you personally can be liable for these things and like what would happen is incarceration, as in like you guys would go to jail. I mean, if you guys do a crime, you guys go to jail. So like if it's a crime, whether it's if it's a white collar crime, you guys are gonna go to jail for doing this crime. So you guys should really think about the legalities of this stuff, like the realities of this stuff in regards to like the law. Uh, so like just something you guys to think about. Is I'm sure you guys won't be in a situation where you guys have to write in a number that's different, or like maybe like there's like some kind of like other thing. I don't know. Like you can there could I don't some kind of financial thing. I don't know. You guys they might there could be like a financial thing like whatever it is. If you guys get a feeling, if you guys have a feeling that's wrong, if you guys feel like it's wrong, you know, you think this is wrong. You're like, this is kind of wrong. This feels wrong. Uh, Whatever it is, you know. maybe it's a company that you never heard of, or like there's like this mysterious company, the mystery company, right? Um, or like a company that looks fake. It's fake, a fake company, you know. If that could be it, you know. Or like, and then this fake company has a number. I don't know how. It doesn't make sense, right? You'd be like, how does this fake company have a number? And like, why are we sending this fake company money, right? So like, that's one of the things that should like trigger a alarm. They should be alert about like that kind of situation as well. But there's lots of things that you guys can like look into. If you guys are interested in this, like if you guys are more interested in like auditing and like financial crime or like white collar crime, financial crime, if you guys are more interested in that, because like this channel is going to be more related to like auditing, like how to audit. And like auditing necessarily doesn't mean like we're going to find a crime. A lot of times it's not malicious. It might just be an accident. You know, it could most of the time it's just a mistake, honest mistake. You know, uh, so like that's really most likely what it is, and that's probably where this channel is going to end. Is like in regards to like, oh, these are just common mistakes, you know, honest mistake. And then we do this audit to catch the mistake, and you're like, oh, you did this wrong. It's fine. You did it on purpose. If you guys are interested in other stuff and other something besides that, I suggest you guys look for a different channel. But that's just this video. Hopefully, will help you guys if you guys are like interested and like thinking like, oh, what else could there possibly be? You guys can look into that and do your own research. Thank you.